Mark, our episode with Dwayne Lydell, your colleague over on the fixed income side, broke some amplified wealth viewership records.
Oh
Do you
yeah,
feel like you have big shoes here today? How are the nerves?
it feels like big shoes all of a sudden. I didn't feel that before you made that comment, but now I do.
I mean, no pressure at all, but I have to ask, what's your game plan for topping Dwayne's performance? How have you been training for today?
Well, clearly, I'll probably have more charts and graphs than Dwayne did, so I
That's
think
fair.
that's always my basic blocking and tackling plan. But maybe a little market volatility here the last week or so might help us a little bit too.
There you go. Yeah, we joke around that our viewership is can be a contrary indicator of what investors should be doing. It typically spikes when things are going rough, right before a market turnaround.
Yeah, we always within my group and student of the market as well, always joke that volatility, some market pullbacks, bear markets are good for business for us. So a little bit of a contrary indicator, like you say. So,
Great, great. So, you ready to get started here?
yep.
All right. So, Nick, cue the music. Joining me today is Mark Peterson, Director of Investment Strategy and Education at BlackRock. Mark has spent the roughly last 2 decades helping advisors and investors make sense of markets across equities, fixed income, alternatives, really the full landscape. Before BlackRock, he was at Deutsche Bank, where he led product strategy and helped shape investment solutions across asset classes. And earlier in his career, he even spent time on the trading floors of the Chicago Board of Trade and the CME. So today we're getting a perspective from someone who's seen markets from the trading floor to the portfolio construction piece to investor education. Mark, great to have you on Amplified Wealth.
Thanks for having me on.
So when you're not thinking about markets at all, how do you actually like to spend your time? What helps you shut your brain off from the work environment?
Yeah, we're in Arizona, so we play a lot of golf. We're close to a lot of golf courses, and this is the waste management week here in Phoenix.
Right.
So a lot of golf courses at our disposal.
So do you frequent the open, or is that something you stay away from?
Yeah, stay away from at this point,
Yeah.
unless you have some high passes that get you into protected areas. That's usually the best way to go.
Gotcha. So let's jump in. You have some slides to share with us, right?
Yeah, we've got what we call student of the market, which is something we send out monthly to advisors that you're making available to everybody, which is great. Something that we send out on a monthly basis, just insights on the market, things that we're seeing also in portfolios, could be interesting things within the industry as well. So just little nuggets here and there, not meant to be a market outlook per se, but we certainly weave some of that flavor in. I always think this is a good time of year to do this too, where you get you can look back at last year and then also look forward to 2026 as well. So well timed, and that's kind of the way we set up the January edition here.
Sure. And I really enjoy the Student of the Market every. I think it comes out monthly, right?
Yeah, exactly. Monthly, usually about within the first week, 10 days of the month, depending on how quickly we can get it approved through compliance. So always a little bit of a wild card, but yeah, usually around that time frame.
Yeah, I love looking at it at least once a quarter, usually most months, just because I think it does a great job putting things in the perspective of the end client. You know, some nice, interesting tidbits that help frame things around the stock market, whether it's bonds, stocks, or alternatives, that the viewer who may not be privy to all the different financial concepts can wrap their head around and help them understand what's going on and how they should think about it with some pretty cool visuals. So let's jump in.
I know that's certainly what we're going for. Want to keep it simple, make it a picture instead of something else that we all have to read. So, being a chart and graph person, though, we'll try to bring this one to life as much as we can, and just get after it. I think one of the interesting things heading into this year is we've had three really nice years in a row, in stock market gains here in the U.S. So if you look at the last 3 years, you see it on the left, 26, 25, and almost 18 last year for U.S. stocks. And and we do this a lot in Student of the Market, is lean on history. It's the old Mark Twain, history doesn't repeat, but it often rhymes. Just looking back over 100 years of history, we actually have 100 good years of stock market data now. You can see it's only the 9th time that this has happened where you've had 3 consecutive years above 15%. And you see all the years on the right side. I couldn't jam any more numbers in that chart there. But you can see that these periods actually overlap quite a bit. So there's only been a handful where we've seen the stock market have 3 good years in a row like we've seen the last 3. It happened first in 42 to 45. So really the back half of World War II when the Allies started to win, the market rallied on that. You had four plus 15% years in a row. In the 5th year, you were slightly down in 1946. Then 1949 to 52, 4 years in a row again. 1953 was slightly down. Then more recently, you had the big one leading up to the technology internet bubble, 95 to 99, 5 consecutive years above 20%. I think we all forget how much stocks were up in that technology bubble, especially in the mid 90s there. But the 6th year was slightly negative. And then very recently, 2019 to 21, we were interrupted rudely by 2022 when inflation and interest rates went up and stocks were down about 18%. And then you see the last 3 years where that fits. So 6 out of the last 7 years have been above 15%. With again 2022 in between, but just thought that was interesting from a historical perspective. You've had 3 out of 4 times when this happened, you had a 4th year, which is pretty consistent with what we see historically. So always like to add that historical context so we can better understand where we're at in the cycle.
Sure. I didn't realize how rare it was to see 3 years of 15% plus returns.
Yeah, our reaction was the same. Yeah, that you would have thought there were some stretches where that wasn't that big of a feat to beat, and maybe we're jaded by some of these recent periods as well. But yeah, certainly you look back, especially in some of the 80s. Those were some good stock markets where you just didn't see this play out this way.
Right, right. So from your seat, from your day-to-day job, what's harder for advisors after a run like this, do you think? Do you think it's calming fear of a pullback or preventing overconfidence?
Yeah, I think you get both ends of the spectrum, right? There's no question, and we'll talk about it in a bit in a couple slides. You see a lot of complacency where folks think stock investing's easy, right? Buy the Magnificent Seven, buy an individual stock, maybe their neighbor, their relative recommends that's done really well, and that's all there is to stock investing, right? In these good markets when everything seems to go up. And then you have other periods where everybody's waiting for the pullback that never comes, right? Or they buy, the market seems to, anytime we have some weakness, tends to rally back. So that definitely, both ends of the spectrum are a challenge, I think, depending on the investor.
Right. Right. And I like how the tech bubble buildup is on here, because I think that's a major focus of many clients right now, many viewers right now, is that fear that we're in another environment where the chips could fall off the table, or the rug can be swept right out from underneath you.
Yeah, no question. That's a big question we've been getting. Just is this another technology bubble, right, that we saw in the early 2000s? First off, I don't think we recall how much stocks were up, right, in this period, which certainly the slide highlights. And also we think the earnings are just more durable, more powerful than what we saw back then. We've got some slides. I didn't, one of the few I left in the bag today, didn't bring them to this session, but we've got some of those that show the difference, especially towards the end of the tech bubble. Some of those companies just weren't able to continue or even actually show any kind of earnings growth. So very different this time around, we think.
Sure. So how does what we saw in the last 3 years, how does that compare to average returns, historical average returns?
Yeah, if we look back historically, stocks average about 10% per year. And, they can vary widely, though, around that 10.5%. So again, this goes back 100 years. This is a chart that I always love to update. We do this at year end, just looking at the calendar year returns by range. So where do calendar year returns for stocks fall? and within a certain range. So you can see on the left side, we've got in the reddish colors, 26 years out of 100 where you've lost money. Then you move to the middle, and I think this is one of the most interesting parts here, is look at between 8 and 12%. So right around that 10.5% average. Stocks only land there in a calendar year return 6% of the time, or 6 calendar years. And then probably most powerful, look at the far right side. I think it just jumps off the page. 38 calendar years out of the last 100 where stocks have been up 20% or more. Just hang around for those great years in U.S. stocks. That's how you build wealth over time. It's the price, right? The volatility, the uncertainty around the average that is really the price of investing in equities, because they average 10, but very, very rarely land there.
Right. So am I reading this right? So six out of 100. So 6% of the time, return ranges actually meet that average return range.
Exactly. Yeah, we're nice where you got an even 100 years, so it makes the math easy here. Yeah, 6% of the time, 26% of the time on the left side, you lose money in a calendar year. So basically 1 every 4 years, you lose money in stocks. But again, 38% of the time, you're making over 20% or more, or even thinking about it, more than 12%. That's 54% of the calendar years on the far right side. So I think pretty powerful just to understand how stock returns play out over time. I think maybe this will help with some of those emotional challenges folks have when you get a big period of uncertainty or pullback or whatever drama of the day is going on.
Right. Yeah. So historically, the numbers are skewed towards positive returns. And it's funny that 6% of the returns, 6% of the time returns are between 8 and 12%, because that seems like the analyst sweet spot, right? In the beginning of every year, it seems like a lot of them, consistently 8 to 12%, somewhere in that range, right? Even though that's rarely what actually happens.
Yeah, and especially this year, you saw all the analysts forecast right around that 8 to 10% range. And I wanted to tap them on the shoulder and be like, hey, you rarely land there, so you're kind of betting against the odds.
Right. It's like it's betting on 00 while playing roulette type of thing.
Exactly. But moving ahead, one thing we talk a lot about in Student of the Market is just how much the market jumps around day to day, week to week, month to month. And I don't use any type of fancy volatility index. I find I can't explain what that is to an end investor. So I use the fancy metric of plus or minus 2% trading days. So just any day the market's up by 2% or more, or down by 2% or worse, I count that. And you can see what I do all day with my time, by the way, is count these 2% days. And I think it tells a fascinating story over the years. You see it on the chart here on the left side by calendar year. And you can see that with volatility of the market, it tends to be either all in or all out, where it's either in our face or it fades to the background.
Sure.
And really, it's always around periods of economic concerns. So you just look at the big one. 2008 was the global financial crisis. We had 72 days where the market was up or down by 2% or more. Certainly, those who lived through it felt that way. That's one every 3 or 4 days, because the market's open about 250 days a year. 252 days this year. So 1 out of 3 or 4 days certainly felt that way. But look at some of these other periods. More recently, you had 44 back in 2020 during the pandemic, or 2022 when stocks were down 18, you had 46. So I think it just shows a nice contrast between those periods where the market doesn't seem to be concerned at all about the economy, right? You have some 0 years here, right, where you had no volatility. Last year, interestingly enough, you had 13, good old lucky 13. But it was almost all concentrated in the first part of the year, especially April. I tried to highlight that in the middle in the box. You had 8 in April. And if you recall what was going on in April, it was all about the tariffs and the uncertainty that policy changes would bring. So there's a lot of concerns that the economy might fall into that recession. So you saw a lot of volatility March and April, and you can see the performance of the stock market kind of matched, right? When you had volatility, you had some negative returns. It doesn't show up on the chart on the right, but we were down almost 20% in U.S. stocks at one point in April. Then we were up 9.5% on April 9th when they walked back some of the extreme tariffs. Third best day since 1950 in stock market history, by the way. Again, you can see what I do all day with my time. But a good to understand where the volatility in the stock market comes from. It's all about how the economy is doing, how the market is digesting where that economy is going, because the economy will dictate what kind of earnings, what kind of profits, the ability companies to pay out dividends. That's what drives stock prices at the end of the day. And the root of that is the feeling on where the economy is headed.
Right. Those 0 years seem unbelievable to me. I'd be sweating if this was my slide and I, was showing a year where there was 2% moves up or down. It just
Yeah.
seems unfathomable to me.
Yeah, it's always the kiss of death too when we update this chart. The next day is going to be a 2% day. So I have colleagues
Right.
here who joke that I need to let them know when we're going to update this one so they can at least go long volatility.
Yeah, and volatility, I think, is a huge thing for investors. To me, it's the price of admission for long-term returns. You're not going to get the long-term returns unless you have to stomach the volatility. We're rewarded for the risk we take, but it makes you wonder why so many investors still treat volatility like it's a signal that something's broken, as opposed to, this is what's supposed to happen.
No, absolutely. And that's why we like laying out this chart and connecting those dots. If you can understand where it's coming from, and then you can assess it yourself, right, on how big of a concern that is. And think about all the uncertainty back in the COVID pandemic and shutdown, right? We had 44 days, and most of those, though, were in the first half of the year, and then it faded to the background pretty quickly. So I think always something to keep an eye on. Not that you need to tally 2% days like I do. We'll do that for you. But I think it's good to help balance those emotions, right? If you better understand where the volatility is coming from.
Right. And I love hearing people on the news, CNBC or Fox, whatever, however you digest your investment commentary, they'll have someone on and likely usually it's an advisor who'll say something like this, where, they ask, what do you expect over the next 6 months or year? And it's always, oh, well, you expect heightened volatility. Right, you're always expecting heightened volatility, and I actually like it a little bit because I think everyone should always be prepared for it. That's what you're signing up for being a stock investor. But it's funny how, I bet you in the beginning of 2017 there was someone out there saying, "Yeah, I would expect heightened volatility this year."
Yeah, no, absolutely. It's the default answer, right? If you
Right.
don't have any conviction, just say, "Oh, volatility is likely to increase." We actually have had one day so far this year, so far through January, that was a 2% day. So
Mhm.
we're at a modest pace, even though it might feel like volatility is up a little bit. We've only had one 2% day, which again, you analyze that out, that's a little bit less than 12 at this point.
Right. So something that stands out to me, I think I'm reading this right. 2020 had 44 times where we saw 2% swings or more.
Correct.
So obviously there was the COVID, sell off, right? As the global pandemic ramped up, but I think that's also important for investors to understand, is that volatility doesn't always have to lead to bad calendar years or bad 12-month periods. It actually could lead to some great periods. I mean, 2020 was a very good period for those who were invested and were able to stay invested through that initial dip in the beginning of the year.
Yeah, no, absolutely. It's a great point. Certainly don't imply that. Do you see some other years like 2009 was a good year post financial crisis, and you had 55, right, in these 2% days. Some of those 2% days are plus 2%er. So no, absolutely. It's a great point. And we should probably clarify that because you're right. Some of these periods, when you do have a little bit more volatility, it actually works out in your favor.
Right.
Stepping ahead, technology stocks obviously been a big part of the story the last 3 years. All the excitement around artificial intelligence driving a lot of the returns in the stock market. You see on the left side, technology actually had a pretty good year last year, up 24% versus the stock market broadly up close to 18. But something interesting happened underneath that, where technology stocks actually got a little bit cheaper based on a price earnings ratio. So just looking at these ratios, this would be for every dollar of earnings, you're paying $40 in the stock price. You can see it actually went down slightly. It is not a huge screaming sale, but it did go down. And it's just unusual to see that when you're actually up 24% in technology stocks. So they were up 24%, but the earnings were up so much that it actually overwhelmed that price increase. And I think this chart goes to a little bit of what we were talking about, comparing it to the technology bubble, where you see on the right side, this is trailing 12-month earnings, so pretty conservative. We're not even including future expectations, but you can see we're at 39 today versus we were 52 back at the height of the tech bubble. So certainly not cheap, but we thought it was just a fascinating dynamic last year where they got a little bit cheaper, even though they had a good year.
Right. Right. Since you brought up the valuations now versus valuations back during the tech bubble, do you think valuation risk is the same thing as bubble risk? How do you interpret or separate them, or maybe combine them in your head?
Yeah, well, valuation, generally as a predictor is not a great predictor in the short term. We've done a lot of work on that. So think 1 to 3 years. If you have a stock or even the stock market has a high valuation, it tends not to be a really good predictor of returns over the next 1 to 3 years. It does tend to be a pretty good predictor over long periods of time, like 10 years, though. Because at some point you're going to have a bear market in there that's going to hurt, especially those that have done well and are priced expensive are going to get hit the most. So we do see it as a longer term trend, but in the short term, it's really hard to use valuation as a predictor of those returns. And from a bubble standpoint, I think it's always tough to exactly define when do you reach that bubble level. Certainly from a return standpoint, we can go back and contrast this period versus the tech bubble, and the returns aren't even close yet to what we experienced back during the technology bubble. So I think even just the overall level of pessimism or skepticism that folks have, the fact that we're asking whether it's a bubble or not, those kind of questions weren't being asked during the technology bubble or the internet craze for the most part.
Right. No, I agree. Valuations are just one ingredient of many when thinking about bubble risk, right? It's a sign of how richly things are valued, but what are people thinking about it? What do the earnings look like? What's the profit margins like? There's all these different inputs that we have to consider when thinking about that bubble versus valuation risk conversation.
And the technology bubble wasn't about just being expensive back then. It was about the fact that the earnings were not durable and they weren't able to deliver on that, and the earnings fell off the table. And that's the 1-2 punch when you're expensive and then the earnings don't follow through, prices fall dramatically.
Right. And on the earnings side, it clearly shows it in the slide. And I like that you guys have it here, how tech continued to outperform the broader market last year while earnings actually went up, which brought the PE ratio down. I can't tell you how many times I talk to clients about or answer or field high PE type questions. And we have the conversation about, well, prices don't have to fall in order for PEs to adjust. They can, but the PE equation is literally two moving parts. So you can also have earnings grow in order to right size PE as well.
Yeah, exactly. And that's really one of the big drivers of the market. And, we've been talking about the last couple of years. When you get down to it, well, the strength of this market has been an economy that's been amazingly resilient, and the fact that we're getting lower interest rates from the Federal Reserve. That 1-2 punch is why earnings can be as strong as they are, right? Good, resilient economy and lower interest rates from the Federal Reserve is a nice formula for this, not just technology stocks, but the stock market as a whole. Right.
So do you have any thoughts on the recent shift in market leadership that we've seen since late October? Since late October, just for our viewers, the equal weighted S&P 500, which is a good measure of just the broad market, just because it reduces the concentration in the largest stocks. It equal weights all the stocks as opposed to market cap weighting them. The equal weight since the end of October has outperformed U.S. technology sector by more than 13%. Do you have any thoughts on that recent switch?
Yeah, no, absolutely. It's something I think we've slowly start to see happen. Then all of a sudden it happened quickly here in the last couple of months. And it really comes back down to the earnings. If you look, think back to 2023, right, when we were up over 26% in U.S. stocks, mostly from technology and Magnificent Seven. Coming out of that COVID restart, all the earnings were coming from those big, large cap growth companies, right, technology based. They had explosive earnings. Yet a lot of the traditional stocks, value stocks, had a really tough time getting back on that earnings train post COVID. It slowly got better. So you think back 2023, all seven of the Magnificent Seven beat the S&P 500, and I think the worst one was up 50%. And then in 2024, we were up 25%. Only six of the seven of the Magnificent Seven outperformed. And last year, only two of the seven outperformed. So I think what you've seen slowly happen is the rest of the stock market, some of those value stocks, the earnings have finally caught up or at least flattened out. You're still seeing great earnings, obviously, from those technology companies. But it's to the point now where the earnings are a little bit more in line and not nearly as big of a gap as what we saw in 2023 and 2024. So that's why we think this market broadening story will continue in 2026. We actually still like parts of the technology story where we're leaning into it, but we think it's going to be a much broader game in 2026. And it's just kind of slowly happened then more abruptly here in the last couple months, which probably not unusual for the market. You get some momentum behind that trade into value and other parts of the market. More folks feel comfortable going there.
Right. Which brings you back to the earnings versus what you're paying for the price conversation. It doesn't matter how great of a company you are. If you're currently trading at a price that's way too rich for your earnings, that's going to likely hamper your investment returns as opposed to a stock that might be priced, below its earnings or at a better valuation with maybe earnings that aren't growing as quickly, but that PE ratio, investors are going to pay for what they're going to get, right? And at some point, even the best earning company, overpaying for it, investors will start to shy away from it.
Yeah, and I think part of it too is the old expectations, right? You had a really low bar for everything outside of growth and technology. So you start hitting that bar and surpassing it. All of a sudden, stock prices there cooperate a little bit more. And the opposite's true too, right? You have such a great run in technology expectations. Sometimes, even if you hit those high expectations, it's not good enough to keep stock prices up.
Right. I guess we'll see how earnings expectations evolve over this year, and if that leadership shift has more legs, or if it will revert back.
Yeah, and maybe we'll do that. And this is one reason why I love these conversations. Gives me ideas for slides next month. Maybe we'll do that chart where we look at how much of that gap has shrunk over the last really 12 to 18 months.
Yeah, I'll have my people reach out to yours. I'm sure as long as you cite Amplified Wealth, we'll be good.
I was going to say, we have no problem stealing your ideas, making them our own.
There you go.
Shifting gears a little bit on the next slide, always another one of my favorites, and you can see I have a lot of favorites, but looking at just the diversification that a fund, either a mutual fund or an exchange traded fund, but it could be any kind of diversified vehicle where you have a lot of different stocks included. To your point earlier, one of the concerns you have in this type of stock market is the complacency angle, where folks just think stock investing is easy. Just invest your dollars, the market goes up. This looks at the individual stocks in the U.S. stock market. So the two big exchanges now are the New York Stock Exchange and the NASDAQ Stock Exchange. You can see we're down to 3,400 stocks. This was as high as almost 7,000 at one point, by the way. But over the last 3 years, right, and that last 3-year period was 3 years above 15%. If you actually look at individual stocks here, 42% actually lost money over that stretch, which I think always is an eye-opener that, right, hey, individual stocks is a much more difficult game than it seems on the surface. And then you look at the bottom, obviously BlackRock is a mutual fund, exchange-traded fund firm, but we just highlight the additional diversification of a fund where you just don't own one stock, right? You can own a lot of different names, a lot of different parts of the stock market. You only had 2 out of 2,300 of those stocks lose money over that period. So just good reminder why we like mutual funds, exchange traded funds to help build portfolios. Just the additional downside risk and the additional diversification, just pretty undeniable.
So when you say diversified funds, does that include like sector funds and all stock funds, or is that only funds that blend in multiple asset classes like stocks and bonds?
Yeah, we only looked at U.S. stock funds to try to get the
U.S.
most
stock funds.
comparable,
Okay.
but
Hmm.
it could be a sector fund, right?
Okay.
That is concentrated just to one sector, one industry of the market. So there's some of that in there, and that's probably those two that are down are probably those that were pretty nichey and focused on one small part of the market.
Right. Wow. Okay. So for every 10 stocks that were picked, at random, 44 of them, four of them were losers. Interesting.
Yeah, exactly. And you see we just pull for full disclosure on the right, you can see all the various time periods, right? You can see over the last year, even though stocks were up almost 18, it was a flip of the coin, right? You had 51% of
Yeah.
individual stocks lose money. So again, just a little bit of the risk underneath the surface, I think is always good to highlight in these type of markets, just so you don't get too much complacency there.
Do you think people underestimate the risk of single stock investments?
Yeah, without question. Because it's not only just losing money, it's the amount of money you can lose, right? You have some of those names, and maybe we should highlight that level of detail here as well, just so you can see it that some of these stocks, it's not that they're down 1, 2, 3%, right? They can be down 30, 40, 50% in a given calendar year, even when the stock market's up. So it's not just the fact they lost money, but the amplification of that loss. That's how you impair portfolios over time, right?
Hmm.
Think about a gap. If you were down 20, even 20 or 30% when the stock market's up 17, that's a big hole to dig out of
Right.
and a big gap to make up.
Right. It makes you wonder, is stock picking really about trying to earn more, or is it about feeling like you're in control more?
Yeah, certainly. One of the things we always try to highlight is you want to be up, right? You want to get a good chunk of what the market's up when in a good market. You don't need all of it, but you need to do better when the market gets hit. And, so you want to lose less. We call that the winning more by losing less story. And for us, that's just a critical piece to the overall puzzle, right? Don't get too greedy in the up market, but make sure you're diversified, prepared for when that tough market comes. That's how you build wealth over time. It's just not the glamorous path to get there.
Right, right. So like one tree can fall in a storm, right? And it might even be the seemingly strongest tree that falls, but the forest as a whole is much harder to knock down. I suppose that's a good way of thinking about it.
Yeah, no,
Interesting.
absolutely.
It's interesting to see, and it makes sense how few diversified funds are down over a 3-year period.
Yeah, and you see some of the other periods, you do pick up some that
Right.
have lost money, 119 over the last 12 months. So there's certainly that aspect. But again, I think you see it play out over time, right? That level of diversification just brings so much to the table. None have lost money over the last 10 years. Pretty undeniable.
Right. Right. This is a great slide. And I don't look at the slide and say, all right, you got to stay away from individual stocks. I think it just reframes things a bit and says you need to be aware of the risks you're taking, right? And the importance of leaning away from strong concentration and more into diversification, with this your stock selection in general.
Yeah, no, absolutely. Certainly wouldn't steer folks away from owning individual stocks. But our risk folks always like to say the worst risk you can have is the one you don't know about. So at least you understand going in what you're getting yourself into here.
Right. Right. And it's a great slide for framing that because I think many investors, they think about a company, especially if it's a company that they know they're using a lot of their products or services in everyday life, and they just have this automatic assumption that it's safe. Right. But when you use a risk lens and say, well, the amount of risk you're concentrating into one basket or to, just a few companies, right? It doesn't take, it would take a lot to your point earlier, to dig yourself out of a hole should one start to slide on you.
Yeah, we see it all the time now. You get folks who've worked at a company for a long time, or right, just invested early in something like Apple, and the returns are tremendous, and they have very concentrated portfolios based on that one position. And how do you get out of that without generating enormous tax right challenges? That's a challenge that we see quite a bit. But a lot of it has to do with right, that stock might have done well here for you, but right, individual stocks still carry a lot of risk, and you need to understand that.
Right. Do you hold on to that position, not trigger the tax, or do you just eat the tax? Right. That's the age old question. And for many people out there, eating the tax actually makes more sense from a risk management perspective, because you don't want to be in the situation where the position slides down and instead of paying taxes, you just have less money.
Yeah, no, absolutely. And there's other, somewhere in between where you can do a little bit of both
Sure.
just to work down some of the risk and some of the tax consequences. So probably some conversations you're having on a regular basis.
Right. Very true. Very true. And very important to bring up. There's several strategies out there that help people diversify concentrated positions in a more tax efficient, risk aware manner.
Yeah, no, absolutely. Just shifting gears back to the economy for a moment. We always update this one at year end as well. Just looking at the length of economic expansions on the left and then the recessions on the right. You can see we're 68 months into the economic expansion here. Historically, that's right on average, 5+ years for an expansion. But I just highlight the economy changes and evolves over time, and the economic expansion just lasts a lot longer than it used to. You can see the most recent one was 128 months from June of 2009 to February 2020, and would have kept on going if we didn't hit the COVID pandemic. So I always think that is important to highlight the fact that the economy is much different, not nearly as boom and bust as we saw 50 years ago, 100 years ago, when we were much more manufacturing driven, much more service and technology related economy today that just can run a little bit longer. And not that that isn't without its own risk, right? Think of some of the recent recessions we've had, right? Some of that's due to the fact that you do get long economic expansions that can lead to some excesses in an economy or financial markets as well. But I thought that was interesting just to go back to that economy, because again, for us, that's the two pillars of why the market's been able to do so well, why we're optimistic in 2026. Is you get an economy that avoids a recession and the Federal Reserve that's likely to lower interest rates. That's a sweet spot for stocks.
Right. Right. I just had a back to fourth grade type of a visual in my head when you said that we're right around average, right? Because I can see some viewers saying, well, we're right around average. That means we should be prepared, right? Be prepared for the, what's going to drop. But, there's this now what did we just learn class type of type of thought in my mind of, rarely our average is what you should expect the outcome to be, right? It is generally, exceeding the average or below the average that gets you to the average.
And also look at the trend, right? The more recent trend is these longer periods, 128 months. That's 10+ years of an economic expansion. That was the longest economic expansion in history. So I really think, that's more of our new reality going forward, which should be good for stocks, but doesn't mean that we're exempt from risk.
Right. And I don't know about you, but I have this theory. You brought up that the expansions have been getting longer as time goes on. I have this theory as Americans, right? We're trained to flood money into our 401ks, regardless of what's happening in the market. It's become easier and easier to invest. It makes you wonder if that flow of money, that natural flow of money that we just got used to in our lifestyles occurring, if that helps support these longer cycles as well. Or maybe it's just the Fed and our politicians getting better at managing the economy too.
Yeah, certainly. You think about the stock market, and Rick Reeder, one of our folks, talks a lot about this. We highlighted that there's only 3,400 U.S. stocks in the stock market today. There was almost 7,000 back at the peak in the late 90s. And like you said, it's much easier to invest in stocks than it used to be. So stock ownership, whether it's in a fund or individually, is much higher than it used to be. So you have a shrinking supply of stocks, yet you have more demand coming in across the market. We think there's no question that helps stock prices in the near term, especially, again, in an environment where you're avoiding recession. I think it's just what they refer to as a technical in the market, but just that supply demand dynamic is such in the favor of stocks right now. I think that certainly helps us.
Sure. Now, do you think the industry has gotten better at preparing investors for recessions, or are we still underestimating how emotionally disruptive they are?
I think we talk a lot about this on the behavioral side, that even though we have the tools to educate, it still doesn't, the education, or at least the once you get into the heat of the battle, doesn't seem to change the response. Because you think about, and we've lived this, right? The last handful, 10, 20 years. Think about each period that was really traumatic, whether it's global financial crisis, tech bubble we mentioned, or even COVID. Each one's very different, unique in its own way, but the behavioral reaction is always very similar.
Right.
I think that, saw some studies that during the first couple months of COVID in February, March, April-ish time period, a third of retirees sold at least some, if not all, of their stock on a specific retirement platform. Right.
Wow.
That's the type of reaction you see. And you'd hope education makes it a little bit better, but it seems to be maybe at best at the margin. Some of these emotional forces can just overwhelm folks during these periods where you don't see any light at the end of the tunnel.
Right. 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 So from your vantage point, it feels like there's more damage caused by the narratives built around the recessions and how people react to that than, the recessions themselves.
Yeah, no question. And heck, you don't even need a recession, right? We saw last April the market pull back as much as it did in anticipation that you might start to teeter on the edge of something on the right side of the slide here, but it wasn't the case, and the market did rally on the back of that. So yeah, no, I think there's no question. Concern about that recession can cause the market to pull back a bunch just by itself.
Sure.
Switching gears a little bit on the bond side, here's that same chart we looked at earlier, but for bonds. So just range of returns for bonds and fixed income. And this is probably intuitive for most folks, but I still like the contrast between stocks. Is you look at the range of returns and everything falls in the middle on this chart, where on the stock chart, everything was kind of bookended on the left and right. You can see 77% of the time bond returns land between 0 and 10%. So 77% of the time you're going to get 0 and 10% in a calendar year. Of course, long-term return for bonds are around 5%. But I think just a good visual contrast between stocks. This is why stocks and bonds make such good portfolio partners, right? One zigs while the other zags generally, not all the time, but generally. But you can see 30% of the time you do better than, on the right side, better than 7%, 12% of the time you're up over 10%. And there's been 11% of the time you've lost money in a calendar year. And of course, that one outlier on the far left side that we all lived through 2022, you were down 13%, by far the worst year ever. We can talk about why that happened. But I just think, again, nice visual here. This is the best I could do with colors too, by the way. I always make fun of my colors here at BlackRock. So.
Very Easter themed.
Exactly. But stepping ahead, one of the last charts we have here is, again, one of our long-term favorites, looking at interest rates on the red line. So just the yield on the 10-year U.S. Treasury bond going back to the late 1920s. And then we overlaid bond returns by decade in the yellow bar. So just where do bond returns for that decade land? And this draws the nice correlation between wherever interest rates start a time period, that's generally where the long-term return lands. So look at some of these, just look at 1980s, your double-digit interest rates, believe it or not, back then. And you ended up the decade up 12.4%. Or look at the 1990s and even the 2000s. Look where that red line crossed the beginning of the decade. It was almost exactly where it ended up. And this is just the natural math of bonds and fixed income, is that over long periods of time, your return is going to gravitate towards whatever that starting interest rate was. So you look at, on the far right side, look at where we're at in the 2020s. We're at only a 1% return for bonds so far. We're a little bit more than halfway through the decade. Look at on the left side, though, look at the last time we had really low interest rates coming out of World War II and the Great Depression. Right. You had a 20-year stretch where bond returns were below 2%. Right. And then even into the 60s, you had a 30-year stretch where bond returns were below 4%. And you can see how slowly over time, over that time period, it took for interest rates to get back to more of a normal level, and we'll call normal 4 to 5%. But look at and the red line in contrast to that 40s, 50s, and 60s period. Look at how sharply interest rates went up this time around. Coming out of that COVID pandemic, we reset interest rates higher in 18 months, where previously that other period in the 40s and 50s, that took more like 15 years to get interest rates back higher. So this is one of those where we had to take our medicine in 2022, where interest rates reset higher. That's why bond returns were as deeply negative as they were. But the good news is we're in a much better place going forward, because longer term bond returns are going to be much more in line with average, right around that 4 to 5% level going forward. I think it's important to point that out with folks who I know own fixed income, might have been frustrated with the last handful of years. We're just in a better place. We're on the other side here. And I always like to tell the story here, lean on the history here to better understand why this period was similar, but also why it's very different.
Right. And what this chart isn't showing is that short-term pain investors need to bear sometimes in order to get those higher yields. I mean, you see how drastically interest rates moved up from the 70s to the 80s, right? And how in both decades you actually had positive performance. However, over that period, there were times when bonds had significant pullbacks just because of how quickly rates moved up.
Yeah, exactly. And think about back then, right? If you could get 12% on your bonds, right? Why even own stocks if you're getting that level of return? So one of those
Right.
periods where you're right, it was painful, but once you got there, it was perhaps the buy of a lifetime.
Right. Which brings up a good point too, because I find that certain investors, they look at past performance when judging a bond, whether you're talking about individual bonds or bond funds, they look at past performance to judge their expectation going forward. And that anchoring, I think, puts them at a disadvantage, right? So from your seat, besides physically grabbing someone and shaking them and saying the math is the math, just trust me. How do you help reset that mindset?
Yeah, it's been a challenge here the last couple of years because again, you've had the toughest bond investing return environment in history. I think you're actually still negative on bonds over the last 5 years. If you think about that, that's pretty historic. Never seen that level of losses. So certainly you're right. You just have that recency bias where folks just saying, "Hey, I've seen it. I don't need it." Right? I can do without bonds and fixed income, but you don't have that mechanism to really build that diversification. I think one of the things we show is also show what happens when stocks suffer, right? Some of those periods in a recession, especially when stocks get hit the most, what bonds do in reaction to that. Performance like that, I think, goes a long way to better understanding why bonds fit in a portfolio. So just that simple, hey, let's pull out the bear market years for stocks and see what bonds did. Bonds average somewhere around 5 to 6% in those years. And it's that type of cushion that you're looking to build in. Because again, those deep losses, that's how you impair your portfolio over time. I think it's important to highlight that. One of my favorite charts that I left in the bag today is we look at if you're only down 10%, you only have to be up 11% to get back to break even. But as the losses get deeper, the math really bends hard against you. So if you lose 20%, you have to be up 25% to get back to break even. But if you're down 50, you have to be up 100% to get back to break even. I always think that that helps folks better understand what we're trying to do when we build a portfolio. Stay out of those big losses because that's what's going to impair your portfolio because you're going to need so much more to get back to break even. And that's why bonds really fit the bill there.
Right. And most investors, at least most of the investors we work with, right, they're investing for a purpose. They're not just investing for great returns. They're investing for retirement. They're investing for whatever that next goal is. And bonds can play a crucial role in helping to dampen some of the volatility the equity markets can create, where the equity markets tend to be the driver of long-term returns, while, bonds, and you showed it, while they do tend to have positive returns, right? One of the characteristics that they also offer to the table is helping to cut into and help diversify some of that stock risk you're taking. And they aren't necessarily a, one size fits all, this is always going to work magic solution as we saw in 2022. But 2022 was more of a non-typical year than what you should expect over long periods of time.
Yeah, we find a lot of folks, right? It's not about getting rich quick. For most investors, it's the stay rich solutions,
Right.
which are some of these strategies that lead you down that diversification path.
Right. It's this is the last slide, right? Yeah, it's kind of serendipitous that we ended with this slide because when we had Dwayne Liddell on, your fixed income colleague, the name of the episode was No Pain, No Gain, because we were just coming off of 2022, and the episode was about how in the muni bond market, we just saw a lot of pain, but in order to get that upside potential going forward, right? You needed to see some of that price movement where interest rates went up, prices went down, and now forward expected returns look that much more attractive.
Yeah, no, absolutely. And just to wrap up here quickly, just with our view for 2026, again, lean on that, stay out of recession, resilient economy, and we expect the Federal Reserve to lower short-term interest rates maybe 2 to 3 times again this year. Maybe it's middle till the second half of the year when we get a new Fed chairperson. But again, that combination is still great for stocks. It's just going to be a broader market, right? It's kind of slowly happened, then all of a sudden quickly here where you're going to see more stocks participate in the gains. A more broad market we think is a good sign, right? You don't want just a handful of stocks or companies driving the economy in the stock market. Rather have more float, more the tide float, more boats there. And again, on the bond side, embracing that diversification. Certainly on a better path here, given the fact that we've reset interest rates higher. That diversification always important. We saw that even at the fund level. But again, not forgetting about the fixed income side as well is the best way to build that wealth over time.
Sure. I really appreciate you sharing these slides with us. This has been great. So is there anything non-finance, non-investment related you're looking forward to?
I would just say, enjoying Scottsdale weather here. It's been fantastic. Not to rub it into the rest of the country, but it's been awfully warm here while the rest of the nation's been cold. I'm probably jinxing our weather, but that's certainly going to enjoy that this weekend.
Sure. Do you stay in Arizona in the summer?
We do not. We actually go back to Chicago a little bit, so I'm cheating a little bit there.
Okay. All right. Good for you. This episode's going to come out after the Super Bowl, but do you have anyone you prefer to win? Are you Patriots, Seahawks? What are we looking at?
I'm neither. I'm a Bears fan, so I'm trying to forget our loss in the playoffs to the Rams, who lost to the Seahawks. But I'd have to favor the Seahawks, right? They're certainly the favorite this year, but I don't have any strong conviction there.
Okay. So as I get older, I find that I'm a Giants fan, but as soon as the Giants are out, right, even if the season's not over, as soon as the Giants seem out, it in my head, I'm watching games and it just becomes, well, who do I know, more fans of, right? So, my New England colleagues, would be upset with me if I went Seahawks. So I have to go Patriots just because I can visualize them being happy and celebrating, if they win. And so I'm all for that.
Yeah, and I'm a similar way, unless it's the Green Bay Packers, which we can't have any of that. So as long as anybody but the Packers.
Anyway, well, it was great having you. Thank you very much. Thank you to our listeners for tuning in. If you are listening to us on YouTube, please remember to like and follow. Marketing tells me to point down because that's where the like and follow buttons are. And then on any podcasting app, you can like and follow us there. We appreciate your time, and we'll see you in about a month for another interview. Thank you.
Thanks, everybody.